Hello everyone. Today we are taking a deep dive into this Reuters story. US inflation remains elevated as GDP growth outlook brightens. We are going to break down why prices are not cooling the way the Fed hoped, and why the same tariffs we have been covering are now showing up directly in these numbers. But before that, you are watching Decode Daily News, where we take the biggest business and finance stories and decode them so anyone can understand. If you are not subscribed yet, hit that button right now. So let us get into it. Here is the number that sets up everything else in this story. Annual U.S. inflation held steady in July, well above the Federal Reserve's 2% target. Now notice that word steady right there. Steady sounds neutral. But coming in above target yet again is not actually neutral. It is a continuation of a run that was supposed to be ending by now. And that run has been going on longer than most people realize, for the 65th straight month. Now just sit with that streak for a second. 65 months is more than 5 years straight of inflation running above target. That is not a blip. That is an entire economic era. When something stays elevated for that long, people stop treating it as temporary and start baking it into how they price things, negotiate wages, and plan budgets. And that expectation shift is exactly what worries central bankers the most. Because once it takes hold, it becomes much harder to reverse with policy alone. And one chief economist explained why growth might actually accelerate from here. The July consumer spending and core durable goods shipments data point to a strong real GDP growth rate in Q3. Now here is what that data is actually pointing toward. Durable goods and consumer spending are two of the clearest early signals economists have for where growth is heading next. And both are flashing the same direction here. And here is exactly how strong that signal is. That looks to be running at least 3%. Now here is why that number matters so much. That figure would be double the previous quarter's pace. And doubling your growth rate in a single quarter is not a small shift. It is the kind of acceleration that changes the entire conversation at the Fed. Strong growth alongside stubborn inflation is actually a trickier combination for policymakers than either problem on its own. And a Fitch Ratings economist summed up exactly what that combination means for the Fed. As Jackson Hole beckons, the Fed's challenge is clear. Now that opening line alone sets the tone. Jackson Hole is where the Fed effectively previews its thinking to the world. So when an economist frames the stakes that plainly right before it, that is a signal this speech is going to be closely parsed line by line. And here is exactly what that challenge looks like in practice. It still has considerable ground to cover before markets see 2% inflation as a credible outcome rather than a distant aspiration. That phrase, a distant aspiration, is doing a lot of work there. That is a polite way of saying the Fed is nowhere near declaring victory on inflation, no matter how many times the headlines suggest otherwise. And with growth picking up at the same time, that combination gives the Fed less room to justify cutting rates anytime soon. Now here is the actual inflation number behind all of this. The Personal Consumption Expenditures Price Index increased 3.7% in the 12 months through July. Now that number alone is worth pausing on. 3.7% annually is nearly double the Fed's target. And this is the primary gauge policymakers actually use to make decisions, not a secondary or noisy indicator. And here is the detail that made this reading actually sting. Unchanged from June. Notice the word unchanged there. Unchanged is not the same as improving. Markets and economists were expecting this number to tick down slightly, and when it holds flat instead, that is effectively bad news dressed up as neutral news. Flat is exactly what you do not want to see when you are trying to prove inflation is genuinely cooling. And the details underneath that headline number tell an even more specific story. Excluding energy and food prices, so-called core PCE, which Fed officials use as a guidepost for inflation's underlying run rate, held steady at 3.3% on the year, now on the surface. Steady sounds fine. Held steady on the year looks like stability at first glance. And that is exactly why the next detail in this same reading matters so much. But look at what happened on the shorter time frame. while rising to 0.2% on the month from 0.1% in June. This is the number the Fed actually watches most closely. Core strips out food and energy, specifically because those categories swing wildly month to month. When the number Fed officials trust the most is accelerating rather than cooling, that carries more weight internally than the headline figure most people see in news alerts. And one forecaster summed up what this reading actually means for the Fed's next move. This is data that supports a hike. That is about as direct as an economist gets in public. Forecasters usually hedge their language. They say things might happen or could happen. When someone says a number directly supports a specific Fed action, that is a confident, almost blunt read on where policy is headed next. And that shift in expectations showed up almost immediately in the market's own pricing. Fed funds futures prices reflected about a 40% probability of a rate hike at the central bank's September 15th to 16th meeting after the report. Now, 40% is not a small number for markets to be pricing in. That is nearly a coin flip on a specific Fed decision still weeks away, which tells you traders took this report seriously the moment it landed. And that number only looks more significant next to where it started, versus about 36% immediately before. Think about how fast that number moved. That is a meaningful jump in market expectations off the back of one single data release. When traders reprice the odds of a rate hike that quickly, it tells you this report genuinely changed minds inside trading desks, not just headlines. Now here is the part of the story that connects everything we have been covering. New tariff-induced pressures are likely coming. After trade negotiations between the U.S. and its second largest trading partner, Canada, fell apart on Friday. Now if that sentence sounds familiar, it should. This is the exact same collapse we broke down in detail a few videos ago, and now it is showing up inside a completely different kind of report, an economic data release rather than a news conference. And here is exactly how that collapse is now showing up in the numbers, resulting in new levies on $20 billion of Canadian imports to go into effect. If you have been watching our last few breakdowns, this is the moment those stories collide with this one. We have spent the past few videos walking through that trade collapse and the tariffs that followed. And this Reuters report confirms exactly what a lot of economists were quietly warning about. Those tariffs were never just a diplomatic story. They were always going to show up in inflation data eventually, and now they officially have. And there is historical context here that explains why inflation has been this sticky for so long. Annual PCE shot to a 3-year high of 4.1% in May after the US and Israel launched airstrikes against Iran in late February. Now that spike did not come out of nowhere. A 3-year high is a dramatic jump, and tracing it directly to a specific military conflict shows exactly how connected global politics and your household budget really are. And here is exactly why that conflict hit prices so hard, sending energy prices higher as the conflict shut in roughly a fifth of global oil supplies. This is the part that connects a war on the other side of the world to your grocery bill. Energy prices ripple through almost every other price in the economy, from shipping costs to manufacturing to food production. When a conflict removes that much oil supply from global markets, that is not a regional story anymore. It becomes a direct input into how much everything costs at home. And it shows exactly how a war thousands of miles away can end up on a receipt at your local grocery store. And on the corporate side of this report, the numbers were even more dramatic. Corporate profits jumped by $400 billion, $900 million. Now just let that dollar figure register for a second. That is 1/4 of profit growth for corporate America as a whole, at a moment when regular households are still absorbing higher prices at the register. And that jump looks even bigger next to where it started, after climbing by $74 billion in the first quarter. Now compare those two numbers side by side. That is more than 5 times the previous quarter's increase. And it was the second largest jump in corporate profits on record. While consumers are absorbing higher prices, corporate America just posted one of its strongest profit quarters ever. And that gap between consumer pain and corporate performance is exactly the kind of thing that shapes public frustration with the broader economy. So, that is exactly where my take comes in. But real quick before I give you my take, this video is for educational purposes only, not financial advice. Always do your own research before making any investment decisions. So what strikes me most about this report is how it forces the Fed into a genuinely uncomfortable position. Normally strong growth and high inflation pull policy in opposite directions, cut rates to support growth, or hold rates to fight inflation. But right now, both signals are pointing toward caution at the exact same time. And there is no clean playbook for that combination. For anyone watching interest rate sensitive sectors like real estate, tech, or growth stocks, the September Fed meeting just became a lot more important to watch. A 40% chance of a hike is not a coin flip, but it is high enough that markets will be pricing in that uncertainty for the next few weeks. And that kind of uncertainty tends to show up as extra volatility even before any decision is actually made. What is genuinely underreported here is the tariff connection. Most coverage treated the trade war and the inflation report as two separate stories, but this Reuters piece makes the link explicit. The Canada tariffs are not just a diplomatic headline anymore. They are officially becoming a measurable input into U.S. inflation data. And that connection is going to matter a lot more once the September 8th counter tariffs actually take effect. So practically speaking, if you are invested in anything sensitive to interest rates, this is a report worth rereading closely. Strong growth usually sounds like good news, but paired with inflation that will not budge, it just narrowed the Fed's options heading into fall, and narrowed options at the Fed usually mean more market movement, not less. All right, that is the breakdown. If this helped you actually understand what is happening, instead of just reading another confusing headline, hit like and subscribe if you are not already, because we break down stories exactly like this every single day. Here is my question for you in the comments. Do you think the Fed actually raises rates in September, or do they hold steady one more time, despite this data? Let me know what you think below.